Good morning, everyone. We are listening to the Overberg Asset Management Market Review. With us is Nick Downing and Werner Erasmus.
Welcome to the first investment review of the second half of the year. We had a very strong finish to the second quarter with considerable volatility in between. First of all, the reciprocal tariffs announced in early April, and then the TACO President Trump chickening out. Trump always chickens out is the acronym for the TACO trade, and considerable dollar weakness over the period. And then, of course, we had the bombing of Iran and the war between Iran and Israel, which lasted 12 days, mercifully short, and the oil price dropped back accordingly, a reason for markets to move higher. And attention moved from tariffs towards US fiscal stimulus, Trump's one big, beautiful bill, which is currently going through Congress right now, passed by the House of Representatives, passed by the Senate, but with slight amendments, or in fact, quite a few amendments. So it has to go back to the House of Representatives again. The markets ended up higher, so an incredibly volatile quarter. But of course, one thing that was very noticeable in the quarter was a very sharp decline in the value of the US dollar. So even though the S&P 500 ended the quarter at a new all-time high, in common currency terms, if we look at all the different world markets and measure them all in US dollars, the US market did pretty badly compared to other markets because of that dollar weakness. Attention will now shift towards three upcoming economic policy-focused event risks. First of all, the looming 8th of July end to the Liberation Day tariff pause. Second, the US fiscal package currently with Congress. Third, the growing divide on the FOMC, the Federal Reserve Bank, in the run-up to the end of Chairman Powell's term. First of all, on the tariff pause, even if the deals with trade partners do not materialize in the next 2 weeks, it's highly likely that the pause will be extended. The timeline on the fiscal deal is less clear, but we're assuming that congressional leaders are aiming for a final deal in the next month or so before their scheduled summer recess in early August. On the FOMC question, the latest policy announcement points to a continued wait-and-see approach. But interestingly enough, two key Fed governors are now dissenting from Chairman Powell's wait-and-see approach. And it's notable that both of them were appointed in Trump's first presidential term. Now we're moving on to the US inflation and the Fed. Of course, a lot of the reticence shown by the Federal Reserve is that they're not quite sure what the tariff impact is going to be on inflation. So it's interesting to read this observation. The New York Fed conducted a survey that has shown that most businesses in the US, both manufacturers and services, have passed some or all increased imported goods costs owing to tariffs over the past few months. So that's clearly bad for inflation, but it's also good for earnings. It means that margins will remain intact. And the fact that companies were able to pass on those costs signals consumer resilience, which is also a good indication of the strength of the US economy. Here's a quote from Fed Chair Jerome Powell. What we're waiting for to reduce rates is to understand what will happen with the tariff inflation. The impact on inflation from tariffs will likely be slow to show up, and that's because many final goods sold in stores through the end of May, when the last inflation data was published, were likely ordered pre-tariffs. The pass-through of tariffs, therefore, will only become evident over the next 2 to 3 months. The Fed funds futures market is already pricing in 2 rate cuts this year. In fact, 2 and a bit rate cuts. The last Fed funds futures that I saw indicated 64 basis points of rate cuts in 2025. So we've got a couple of interesting bit of analysis from Capital Economics. They say the following: with all the uncertainty around tariffs, fiscal policy, and immigration, it's not surprising that the Fed has continued its wait-and-see approach. What about the inflation picture? Investors are certainly bracing for a decent pickup in inflation, judging by the surge in near-term inflation swap rates. So that's the 1-year inflation swap rate. Second, will any price hikes morph into a sustained bout of inflation, i.e. the 3-year swap rate, for example, has barely budged? In other words, it doesn't look as if inflation, the spike, will be anything more than just a temporary blip. And if that's the case, then the Fed can surely cut a bit further. Meanwhile, at the ECB, at their latest policy meeting on the 5th of June, the ECB cut its policy rate as widely expected, and according to consensus that ECB will deliver at least 1 more rate cut this year, they brought their rate cut down to 2%, and Eurozone inflation is now below the target of 2% at 1.9%. And if anything, the risk to inflation in the Eurozone is for inflation to fall further because of tariffs and the likelihood of significantly cheaper Chinese goods flooding into the Eurozone market. So there's a big contrast between the Eurozone and the US. Eurozone base rate interest rates at 2%, the Fed funds 4.25%. So now we're going to move on to macro strategy, global summary and equity market outlook, starting off with MRB's view. Additional monetary and fiscal stimulus should enable the uptrend in corporate earnings expectations to persist. Geopolitical risks in the Middle East have eased in the past week. The oil market has largely eliminated its war risk premium. The US-led tariff war remains on pause, and the pause will likely be extended. Economies will help to sustain asset price inflation for as long as developed market bond yields do not break out to the upside. Real oil prices are not threatening, and global oil spending relative to GDP is well below its long-term mean level. Historically, the global economy performs best when oil prices are cheap, as is still the case today. There will be choppy economic data over the summer, but we expect a gradual firming outside the US and no worse than a modest cooling in the US. A recession is not on the horizon, especially with monetary and fiscal policies becoming even more accommodative. Relative earnings momentum has shifted in favor of cheaper non-US markets, reflecting a weakening US dollar, improving earnings growth in select non-US markets. The path of least resistance is likely to be mildly higher equity prices. And continuing with MRB, we expect non-US equities will still benefit the most. Although the greatest policy thrust may originate from the US, policy stimulus is occurring in many other markets of the world. US equities have higher earnings expectations to hurdle and much richer valuations than elsewhere. Our expectation for further broad-based US dollar depreciation is a crucial headwind for the relative performance of US assets. So it's interesting, but the capital economics view is slightly different to that. They're still, like MRB, bullish on risk asset inflation, but they differ slightly from MRB in terms of which markets will outperform. They still believe that the US market will outperform. So I would say that it's good that our global portfolios, and in fact the ETF component of the local portfolios, has got a very diversified global exposure to different markets. With that being said, let's turn to what capital economics has to say, which is the following. With the noise around US tariffs and war in the Middle East fading, at least for now, we think the stage is set for some further decent returns from risk assets, especially US equities, over the next couple of years. So if we look at some of the total return forecasts, and I must stress these are US dollar based, so they're not local currency based, but they're common currency US dollar returns. They're expecting moderate single-digit figure returns across the board between now and the end of 2025, given that we've had quite a strong bounce in Q2. But then they're expecting very solid returns in 2026 and still decent high single-digit returns in 2027. 12.6 in global, 14% in US, 9.2% in Europe, developed market Pacific 11.4, Latin America 6.7, emerging markets Europe and Africa 4.8. Good reason to have global portfolios. Emerging market Asia 12%. In 2027, global 8.5, US 9, Europe 6.9, Pacific developed market 8.1, Latin America 6, emerging market Europe and Africa 4.4, emerging market Asia 8.3. And bonds, developed market government bonds 5.4% in 2026, 4.4 in 2027. US Treasury bonds 5.8%, 2026, 4.1, 2027. So definitely better than this year for bond, but nowhere near as good as equities. But however, a good risk diversifier. The worst performers among developed markets, we think, will be the major commodity exporters, specifically Canada and Australia. We expect commodity prices generally to fall over the rest of this year and next. We're quite upbeat about the prospects of China's equities. The tech sector there has started to catch up with its global peers, thanks in part to the DeepSeek breakthrough and a more constructive attitude towards the private sector from the authorities.
So just in terms of the update this morning, slightly different. I mean, we've not just reached the end of the month and the quarter, but it's also the end of the first half of the year. So I thought it'd be more insightful and meaningful if we give a bit of an update on what happened during the first half of the year and just focus on a few main macroeconomic data points and then give a brief overview in terms of what happened on JSE the first half of the year. I mean, it's been quite an eventful first half, and there's a few global aspects to it as well. But obviously, as we know, there's often global factors got a bigger impact on our South African markets than what local factors have. We've obviously had coming into this year with quite a lot of optimism in terms of the GNU. That was sort of thrown on its head after the whole budget fiasco we had in March, or it started in March, and ended up going through various variations of the budget. I think the big scare in terms of the budget fiasco was the fact that there was a real possibility at one stage that the GNU might dissolve, and that had a real negative impact on both investor and consumer sentiment. Along with that, we had the announcement of the global tariffs in April, and obviously continued tensions between South Africa and the US for various reasons. Again, all those factors playing together, having a very big impact on sentiment. And as we know, if you've got a decline in sentiment, people don't spend money, they don't invest, and obviously you see a bit of a slowdown in economic activity. And then we had the wars that continued in Russia and Ukraine, and also in terms of Israel attacking Iran and the US supporting Israel in that. And yeah, just further fueled this negative environment for investors and obviously uncertainty. As we know, investors hate uncertainty. I think another big talking point first off there was the rally in the gold price. Over the last year, gold is up close to about 44%. Year to date, the gold price is up about 25%. So quite a significant rally in gold. In terms of the local market, that obviously benefited the local gold miners and the JSE quite a bit. The oil price hasn't declined that much this year, but it's down, I think, about 8%. But over the last year, it's down about 25%. That's obviously fantastic for South Africa, being a big importer of oil. And then also it has helped feed through to lower inflation for South Africa. So that's also been quite a theme. And then, yeah, lo and behold, through all this uncertainty, global tariffs, GNU uncertainty, global wars, the JSE actually reached an all-time high in June. So, yeah, as Nick likes to say, a bull market climbs a wall of worry. So interesting that occurred through all this uncertainty. Just jumping to the macro section, I'm just going to focus mainly on call it 2 or 3 data points on the macro side. The first one is GDP growth in South Africa, and then also inflation and interest rates. I think there's been some interesting developments, especially surrounding inflation. But yeah, starting off with GDP, yeah, I think we all came into this year quite excited about the growth prospects for South Africa, especially on the back of the formation of the GNU in 2024. And then also, if you compare the beginning of this year with last year, you had declining inflation, you had lower interest rates, you also had quite a high level of investor and consumer confidence. And if you compare load shedding in the beginning of this year to last year, it was significantly lower. So quite a few tailwinds coming into this year. But yeah, long story short, GDP for the first half of the year disappointed. We only had figures for the first quarter of this year, and GDP was up 0.1% quarter on quarter. GDP figures for the fourth quarter of 2024 was 0.4% quarter on quarter. So yeah, extremely low. And if we just look at some of the data points we've had for this quarter, April, May, and June, it also points to a disappointing second quarter for 2025. So after all excitement, a bit of a disappointment, to be quite honest. If you look at that little table on the right-hand side, it's just a summary of some of the forecasts we have for this year. Compared to what we had in the beginning of the year, it's all these forecasts from these different entities have been downgraded. I would say the average is around 1.7 to 1.9% expected GDP growth for 2025. But you can see that average there of the IMF, the Reserve Bank, Moody's, SPG, which is Standard Bank, Treasury, and then the Bureau of Economic Research, the average is out to 1.3%, which is very disappointing. I think we'll be lucky to get there this year. If we look at the South African Reserve Bank sort of trend growth, the rate at which we are supposed to grow is 2.5%. So we're quite far from that. Jumping to inflation and interest rates, I think this is quite a positive occurrence currently in South Africa. Our inflation for April and May was 2.8% year on year. And that is extremely low. If you just look at the graph on the right-hand side of the slide, it's basically since 2009 up until May 2025. So the only previous time we had inflation year on year at 2.8% was in COVID, when there was basically almost a complete stand in economic activity. So yeah, low inflation obviously creates room for lower interest rates, which is good for economic activity and for financial markets. The South African Reserve Bank forecast for 2025 is 3.2%, which is below the sort of 4.5% midpoint that they aim at. They've got a target range of 3 to 6%. We're actually currently below that. And then for next year, 4.2%, and 2027, 4.4%. So the inflation outlook is very positive for South Africa. I think if you compare it to other EM countries like Argentina and Turkey and Brazil, they've got almost runaway inflation, where we don't have that. So a very positive point at this stage in South Africa. We've had about 100 basis points of rate cuts since the start of the rate cutting cycle. For this year, we expect another 25 basis points of rate cuts. Just looking at, there's been a potential new inflation target announced by the Reserve Bank. They want to bring that down to 3%. I think they're almost done with their research and the analysis that they need to provide to Treasury. So we're very close to decision on that. And they've also noted that the current low inflation environment creates a very nice sort of situation to actually adopt the 3% inflation target. So what does that mean for the general investor and consumer? Or maybe in the short term, you'll have higher interest rates than what you would probably have when you've got a higher target. But as the economy adjusts, you'll have a low inflation going forward, which means you'll have lower interest rates. You'll have a currency that weakens less compared to other developed market currencies, and also very good for South African government in terms of issuing debt or government bonds.